Hello there, everyone, and welcome to our Pellegrini Financial second quarter market update. Now at the midway point, and so halfway through this year, halfway through the summer, of course, which has been going way too fast, as I'm sure you all can understand. Markets, of course, through the first half of the year have done relatively well to this point. And as we look at where gains have been made, of course, have generally been in the technology sector here. Of course, technology was a tough sector in 2022, so starting 2023 is probably not surprising. But certainly in this second quarter, technology led the way, and a lot of it was based on artificial intelligence and that segment of technology and those few companies, I suppose, that lead the way in that. And that's really what kind of led the market, generally speaking. Obviously, we have looked at different sectors here. When we look at the Canadian market in particular, in this top chart here, you see information technology, of course, again, leading that way. But consumer discretionary industrials have also done well on a year to date basis. Um, when we look at some of the laggards, of course, energy, of course, is one of the laggards here in the Canadian market here for year to date. When we look at global markets, again, NASDAQ, which is a tech heavy index in the US, has led the way for the quarter and also for a year to date. The Japanese market as well did well in Q2 and again doing well on a year to date basis. Uh, China being one of the laggards in because the quarter two, and of course on a year to date basis as well. Um, some of the small cap stocks didn't do too well in Canada, and again, negative on a year to date basis as well. When we look at some of the bond markets or fixed income, we'll get into that later too. Bit of a flat performance from a bond perspective at this point. But I think a lot of tailwinds going forward when we get to that particular component. As we look at certain commodities here, and a couple segments I focused on this time around was oil markets again, which now we've seen the WTI up to the $80 mark. Western Canada Select still discounted significantly here for the Canadian markets in particular. The two charts here, one is U.S. oil production here on the top, which has been trending up ever since the lows of 2020. Not quite back to the pre-pandemic level of production. Does it get there? Probably not. We have seen U.S. oil rigs basically in decline as we see rigs move out of the U.S. market. Of course, OPEC is always playing with the markets as well. So oil, well, it does have some positive elements from a barrel production standpoint and the sale price. Um, Difficult to see U.S. oil production maybe getting back to where it was. The other chart here is gold at the bottom, which I've touched on really gold much for as of late, and a bit of volatile, I guess, segment as of late. Decent performer in 2023 and certainly in this last quarter, but again, as you can kind of see in this chart here, has a tough time breaking that $2,000 an ounce threshold. Um, whether that's a long-term trend line that's never going to be broken, who knows? But definitely has had a tough time breaking that level. When we look at more of some of the basics of interest rates, I suppose. Two different charts here that I looked at. Uh, One being the money supply. Now, money supply, of course, maybe you don't talk about too much or see too much about it, but we've have seen a reduction in the money supply as of late, and when you reduce money supply, that's like an interest rate increase, and of course, on the right of that is the interest rate increases across many global markets, so Bank of England, Japan, Euro, Canada, and the U.S. as well. All in many ways lock in step with the rate increases and the dramatic rise of interest rates. And so now, again, we've had a recent cut or increase here in Canada. Probably expectation is still another rate increase in the U.S. Um, but we certainly are nearing the peaks of rate increases. I suppose my own personal concern is have they increased too much, too fast? Time will tell, but yeah, rates have certainly risen a lot. Now, as retirees, that's quite a benefit actually, because as you see, or have you ever seen whatever GIC rate pays, or money market, or certainly high interest savings accounts, they are paying far more than they were a year and a half, 2 years ago. And so, as retirees, this is not a bad thing. again, rates that we haven't seen probably in 20 years. You are now the beneficiaries of that, not necessarily the payers of that. When we come down to GDP, GDP, of course, has come ahead of expectations, and that's probably surprised the markets in general, which probably is a little bit behind market returns here in Q2. Um, I guess and take that with a grain of salt. There's two charts here that I kind of put up here at the top. Again, the one chart here on the Canadian real GDP per capita. So you see real GDP is the top line, continuing to increase. Population growth, immigration, everything else keeps that growing. But the GDP per capita has actually been in decline, and that's maybe not surprising, perhaps, as the cost of borrowing is increased more and more. Consumer spending, or what's available to spend, it should be less and less. Although we've seen some good consumer spending, and so I think that's where you see again what interest rate hikes do, mending to slow GDP. Certainly has done that on a per capita basis, and that's maybe the underlying number to be more not necessarily concerned with, but perhaps more cognizant of. When we look at U.S. GDP growth, and that's on the right here again, uh, a slight improvement since the last quarter, and again that was kind of surprising to economists generally, and so that really has pushed out any talk of recessions into really 2024. And I think recessions are still on the table for many economists. Again, at this point, certainly wouldn't be very strong or deep or concerning. But again, interest rates as high as they are, uh, we are going to see some economic slowdown continue to trend that way, or should. When we look at some of the American employment numbers, and both Canadian as well, but employment still remains strong, and that's partly behind the stronger GDP in Q2. So again, as long as people are working, people are spending. I think I've said that in many different meetings of ours. Um, Consumers have perhaps a stronger habit of spending versus saving, but at the end of the day, that does keep the economy going. The other aspect of how employment is looking here is kind of on the right, where we have Canadian job openings. And this is a similar in the US as well, where the job openings are trending down. Okay, so that is maybe a sign of where interest rates increases are starting to take a bite into the economic growth and to employers. Where that continues to go, we'll see. But again, jobs generally have been remain strong, and that's a good thing, generally speaking, for the economy. When we look at inflation here, gun inflation now has certainly been high on the topic for everyone. Of course, interest rate hikes are meant to combat inflation, and I think seeing in these charts here, both of them specific to Canadian inflation rate, have been doing the job as they're supposed to, which is bring inflation under control. And so the chart on the left there, the longer term trend charts, we saw that big spike up and now kind of a big spike down. Hopefully it carries on in that fashion. The chart on the right, a little bit of a shorter trend line, but inflation getting down to 2.8%. And again, you're still seeing some embedded segments of inflation that remain strong. I talked about that in the last quarter. Um, but inflation does, mean trending down is a positive thing in many ways. I think in regards to specific inflation factors, that perhaps might be some more external events that impact that as well. Obviously, Russia Ukraine has an impact. Ukraine, grain production. Again, they are a low cost producer of grains, wheat in particular. If that's impacted, well, obviously that's going to have an impact to global grain markets, and obviously Canadian wheat is not a cheap wheat, so bread prices, whatever else, you could see that as an inflationary factor. Again, time will tell where that ends up, but those are other external events that can have an impact. When we look at currencies here, a couple different ones this time around. Looked at the Canadian US dollar again. I guess that's kind of similar, but again, it was a good quarter for the Canadian dollar against the US. So again, if you're preparing for snowbirds, if that trend continues, that's probably a good thing for buying US dollars this winter. Um, and that's maybe perhaps a general sentiment across the board or globally, where the US dollar finally, I guess, has relented against as a strong currency. You saw this other chart here at the bottom is the U.S. dollar against the Japanese yen, and again, where the yen was probably underpriced for a period of time there, you saw a lot of volatility in that comparison here as of late. A few economic changes in in Japanese markets as well has kind of impacted that. But again, generally, you've seen a U.S. dollar sell off across the board. And from an investment perspective, most of the Canadian-based investment holdings aren't hedged much, if at all, anymore against most other currencies. And I think that's probably a trend that's sticking for a little while. Where we are going, well, 2023, like I said, halfway through that. I think market pundits certainly are split between where markets head in this fall. I'm perhaps a bit more bearish on my side of things, but that's my own personal take. Market, economics underneath everything is still quite strong. So, for markets to move forward from here wouldn't be all that surprising. I think at the end of the day, right now, market participants are being patient still because you are paid to sit on the sidelines, whether it's money market or high interest savings. Like you said, you are being paid. And right now, I think they're showing a bit of patience by sitting a bit more on the sidelines. Generally speaking, I think most money managers have been underweight equities, or certainly going into the fall here is underweight in equities and a little overweight in fixed income, perhaps a little overweight on corporate bonds versus high grade debt or high grade bonds. Even sovereign bonds, perhaps like government debt, has been maybe more of a neutral status in that sense. I believe markets right now are just again still in wait and see mode. As GDP kind of came to the surprising side, that might pull market participants back in and put that money to work. So I don't expect any really significant downturn per se. That's for sure. Like I said, everything else underneath the hood seems relatively strong, and so right now I think it's a bit of a wait and see mode. So I think I'll leave it at that. I do appreciate you joining us once again. I hope you enjoy these market calls. If you have any questions, always feel free to call in, speak to Parker, myself, or Perry, and certainly we'll have a conversation with you. Thanks again and take care. Bye for now.